when your income is already 7 figures, selling a major asset like your business, your company shares, or your investment property can push your tax bill into the atmosphere. Under the One Big Beautiful Tax Bill Act or TLB3, the rules for exit didn't get easier, but the strategies did. If you plan correctly, you can turn a one-time liquidity event into a lifetime tax advantage. In this video, we are breaking down 5 key points of the successful exit strategy under TLB3. 1. What changed under the new tax law? 2. Share with you a client story showing how planning turned taxes into opportunity. 3. The 2025 tax year framework for planning your own sales. 4. How to position yourself for long-term advantage beyond 2026. And 5. A bonus reinvestment blueprint to protect and grow your wealth after the sale. So, if you are a high-income owner, business owner, or investor sitting on a big liquidity event, this is exactly the video for you. So the sale isn't the finish line, it's the fork in the road. One path ends with the IRS as your biggest investor. The other end with a lasting tax efficient legacy. The difference is all in how you plan your exit. So you have spent years building equity, sweat, and strategy into your business or portfolio. Now you are at the point where the right move could preserve millions or the wrong one could cost you just as much. So stay with me because I'm going to walk you through how $1 million owners are locking in the lowest possible taxes on their exits under TLB3. Alright, let's start with part 1. So what changes under TLB3 and why? Why you want to understand the update can give you an edge before you even list your company or property for sale. So under TLB3, which is the Big Beautiful Tax Bill update, so long-term capital gain rates stay at 0, 15, and 20%. But that's good news, right? No new top rates were added. But the real story is how several planning tools now fit together like a puzzle pieces to create a smarter exit. So you have the Extended Qualified Small Business Stock QSBS rules. So the new QSBS issued on and after July 4th, 2025, the per issue exclusion increased to $15 million or 10 times your basis. There's also a new holding period system, 3 years for 50%, 4 years for 75%, and 5 years for 400% exclusion. Deferred income flexibility, like installment sales, deferred compensation, and structured sale contracts remain powerful ways to spread your gain. Just remember that large deal can trigger an interest charge under Section 453A, so you need to model the carrying cost. 1031 exchange is clarified. You can still use the 1031 exchange to defer a gain when sell investment real estate, but it's strictly limited to real property, so no personal or intangible assets. QBI deduction have been made permanent. So starting in 2026, the 20% qualified business income deduction under Section 199A becomes permanent. So that's a huge win for business owners building our future exits. So here is your takeaway. The tax rate didn't change, but the strategy stuck. The ability to combine exclusions, deferrals, and timing got much more powerful. So now that you understand what changed, let's move on to part 2, where I will share you a client story that brings this idea to life. Because nothing explains tax strategy better than seeing how one person used the tools to legally save millions. So let's move on to part 2. So meet Daniel from Scottsdale, Arizona. one of our long-time clients and a perfect example of proactive exit planning done right. So Daniel built a logistics company over 15 years. By early 2025, a private equity firm offered him 15 million cash and 2 million earned out over 2 years. If Daniel had just taken the deal as is, he would have owned roughly 5 million in combined taxes, so about 29% of his total proceeds. So instead, we built a plan that brought his effective rate down to around 14%. Here's how we did it step by step. So step one, qualify small business stock QSBS. So Daniel company was structured as a C corporation and meet all section 1202 criteria like active trade, less than 50 million in assets, and stock issued directly to him. That qualified the first million of his gain for 100% exclusion, no tax. Step two, installment sales for the earn out. So we applied the installment method. So Daniel earn out would be recognized over 2026 and 2027 instead of all upfront. That kept his adjusted gross income lower each year and reduced exposure to phase out and surtaxes. We modeled the section 453A interest cost, so small compared to the tax savings. Step 3, charitable planning before the sale. Before signing the final purchase agreement, Daniel transferred 10% of his stock into a donor advised fund. Because this was done before binding sale, it avoided anticipatory assignment of income problem. So that portion of the sale produced no capital gain tax, plus Daniel got a full fair market value deduction. By coordinating those three moves, Daniel legally cut off his total tax bill nearly in half and turned what could have been a one-time windfall into a long-term legacy plan. So what can you take away from Daniel's story? The big lesson is that your exit plan has to start before your sale negotiation. So ideally 12 to 18 months in advance. So that's exactly what we will cover in part 3, the SMART strategy framework for 2025. So think of this as your step-by-step roadmap. By the end of this section, you will know what to do, when to do it, and who needs to be involved before your liquidity event happens. So step 1, start from 12 to 18 months ahead. That's when you confirm your entity type, your ownership mix, and your tax exposure. Wait too long and you lose access to QSBS, charitable planning, or restructuring options. Step 2, test QSBS eligibility. If you operate a C corporation, review whether your stock qualifies for Section 1202. If it doesn't yet, consider issuing new stock before July 2025 to start the clock on the new tiered exclusion schedule. Step 3, explore installments or structured sales. Spreading your gain across multiple years smooth income and can lower your effective rate. So don't just skip the math. Factor in Section 453A interest or defer tax balances over 5 million. Step 4, execute charitable or estate gift before signing. So timing is everything. Once a binding agreement is in place, the IRS considers it your income. If you want to give to a donor advised fund or set up a charitable remainder trust, do it before the deal closes. Step 5, use 1031 exchanges for real estate sales. If your sales include investment property, 1031 exchanges let you roll the gain into another property and defer tax. Following the 45 days identification and 180 days replacement rules to the letter. Step 6, coordinate residency and state exposure. For those in high tax states, relocation becomes before your sales can save up to 13%. Just document it thoroughly, like driver license, voter registration, home ownership, so it's audit proof. Step 7, keep cash flexibility. You want to negotiate payouts that match your personal tax strategy. You don't need all the money at once. Pacing your gain by your control. We have now covered how to plan your sales before it happens, but what happens after the sale? That where most people lose control and where high earners can really build wealth if they know what's coming next. Let's move into part 4, planning beyond 2026. Think of 2025 and 26 as your bridge years. So the window between temporary provisions and the next stage of permanent rules under TLB3. Here, what to focus on if you are planning ahead. You want to align your QSBS holding period. So stock issue in mid-2025 hit the 5-year mark in 2030, perfectly timed for the 100% exclusion. You want to watch the opportunity zone reset. Starting in 2027, opportunity zones will restart with a rolling 5-year deferral model. So gain invested before that still qualify for the 10-year exclusion. You want to layer trust and entities. So you can use spousal lifetime access trust or grantor trust to move future appreciation out of your estate while keeping access to liquidity. Also use deferred comp and stock rollovers. So executive and founders can time deferred comp into Section 1045 rollover to manage future tax breaks. You can reinvest strategically. This is where you shift focus from tax deferral to tax efficiency, like blending depreciation, taxable losses, and municipal income to control post-sale cash flow. The main message here, so don't treat 2026 as a finish line. Treat it as your setup year for the next decade. If you are still with me, you have already learned how to reduce tax on your sale and how to structure the timing to stay in lower brackets. Now we are entering the most powerful section, which is part 5, the post-sale reinvestment blueprint. This is where true wealth building begins. After your liquidity event, the question becomes, now what? Here's how top owners reinvest to make sure their wealth lasts generation, not just one tax year. Step 1, form a family investment LLC. Use this to centralize your portfolio and control your investment like a business. It helps with management, reporting, and future gifting. Step 2, establish a charitable remainder trust CRT. A CRT lets you donate appreciated assets, get an immediate deduction, and still collect lifetime income. At the end, the remaining funds go to charity, combining giving with income control. Step 3, invest tax efficiently. So you can use municipal bonds for tax-free income, private credit or real estate fund with built-in depreciation, index portfolio toward qualified dividend and long-term gain. Step 4, manage state exposure. If you are relocating to a no tax state, confirm your income sourcing. Intangible assets follow your residence, but real property is taxed where it sits. Documentation is everything here. Step 5, plan for the next generation. Liquidity moments are perfect for funding trust, foundations, or family partnerships. Right after a sale, valuation can be discounted, and that when to move assets strategically to heirs. So by now, you know the 5 parts. 1, what changed under TLB3. 2, Daniel's life story. 3, the smart strategy framework for 2025 tax year. And 4, planning beyond 2026. And 5, the reinvestment blueprint for lasting wealth. Each part builds on the last, and every one of them can save you millions if you start early and plan intentionally. The one big beautiful bill didn't just keep the playing field level, It gave high owners the clearest opportunity in years to design exits on their own terms. Whether you are selling a business, liquidating stock, or existing real estate, the difference between paying a 40% or 15% isn't luck. It's structure, timing, and execution. Plan your sale before the buyer signs. Spread the gain before it spikes your AGI. And reinvest with purpose, not panic. That's how million-dollar owners turn a liquidity event into a lifetime take advantage under TLB3, and how you can create not just wealth but a legacy that lasts. Thank you for watching. Mia, like, share, and subscribe, and stay tuned for the next video update.